Hi, it's Raoul. Guess what? I can't believe, but we're turning 10 at Real Vision this September. I can't believe it's a whole decade of democratizing the very best financial intelligence and building this kind of super community of finance, including the super platform of finance. And to celebrate, we're throwing a virtual party on September 27th at 12 p.m. and you are on the guest list. It's free to join, so don't miss out. If you're not a member, you can sign up at realvision.com/free. We've also got a trade ideas competition where you can flex your market smarts, plus some exclusive limited birthday merch and much more planned for September. It's going to be a lot of fun. So sign up realvision.com/free and we'll see you at the party September 27th at 12 p.m. That's realvision.com/free.
Welcome back to Pro Crypto. Today, we're doing a deep dive into ETFs and market ranking. I'm joined by two guests from Flowdesk, CEO Reed Worbit and head of OTC, Greg Guttis. Gentlemen, welcome to Real Vision.
Thank you so much.
Thanks, Ash. Good to be here.
Great to have you with us. Looking forward to this conversation. Before we start, I should say a reminder that Real Vision is celebrating its 10th birthday this month. To mark the occasion, we're offering a discount on memberships. You can use the code BDAY, that's BDAY10, to get a discount on Real Vision. Okay, with that said, gentlemen, let's get into it. Listen, I've been excited about today's conversation because I'm fascinated by market plumbing, its relationship to price, its relationship to the overall relationship that investors have in the market itself. Guys, before we get started here, just talk a little bit about what you guys do and what your roles are at the company.
Sure. Thanks, Ash. So I started out, the majority of my career was in TradFi. I worked at some large hedge funds, always on the trading side. I got into crypto in 2016, 2017. I joined Genesis in 2018, and I left in August of 22 as a managing director, heading up their spot trading desk. I joined Flowdesk about a year ago, so I'm coming up on a 1-year anniversary, which is pretty exciting. As the US CEO to build out the team here, really focusing on our product suite as it pertains to market making and OTC.
Greg, over to you.
Sort of a similar background on my end. I spent the first half of my career in TradFi as well. A lot of my time was spent on the equity desk and specifically trading ETFs and the underlying baskets that comprise those ETFs. Back in 2021, made the move over to the crypto side and joined Genesis as well, trading both spot and derivative products over there, and have been at Flowdesk for almost a year as well. One of the first people that was brought on by Reed to help build out the OTC side of the business here.
Okay, let's talk a little bit about Flowdesk, what it is you guys do, the nature of those activities, and the relationship to the broader crypto markets.
Sure. So Flowdesk was founded in 2020. So we've been around for a few years, relatively under the radar. We are a regulated, licensed, full service digital asset trading and technology company. So that's sort of our tagline. We have a team of about 125 people globally. We are headquartered in Paris. We have offices in Singapore, the UK, the US, and Canada as well. And really, what we focus on is market making, OTC, high frequency trading, and venture as that relates to our core business. So, we have trading relationships with a wide variety of counterparts that include exchanges, token issuers, institutions, hedge funds, endowments, ultra high net worth, early adopters and founders, etc. And although systematic market making was really in our DNA and sort of the beginning of the firm, there's just so many synergies and crossovers with our other verticals now that include bilateral OTC and venture. So we've really focused on building that out across spot, derivatives, and credit. So I think one of the topics of today is around the ETF narrative, and that has also helped us position ourselves to be LPs for multiple issuers. I would say, in summary, our mission here at Flowdesk is, to put forth innovative products to our clientele, and really focus on trust, transparency, and innovation for our clients.
So before we get into the specifics of what's happening right now in crypto and the ETF market, I wanted to just do a bit of a definition for folks out there. If we could just explain the concepts as you guys see them in the digital asset space of market making, liquidity provision, and the notion of OTC trading. Talk a little bit about that, how it relates to the businesses, and why it's important to understanding the structure of the current crypto markets.
Sure. So it's important to understand that that there is a structural difference in the product of market making versus OTC or bilateral OTC. So on the market making side, what we do as a company is we facilitate and provide liquidity for both token issuers and exchanges. So typically, a token issuer will provide capital, both stable or fiat, and native tokens, and we algorithmically or systematically manage the order book across a multitude of exchanges. We have connectivity to over 150 different venues, and what we do is we try and smooth the order books. With the result of sort of lowering volatility and creating a better experience for the end user, which in this case is sort of the buyer or the seller of that asset in whatever venue that they're accessing liquidity, whether that's a SEX or a DEX. OTC is slightly different in that it's catered
Let
more toward.
let me jump in there just for folks
Sure.
who may be retail investors who are trying to understand the mechanics of how this works. Essentially, what you're saying is that you're buying and selling with your own capital against an order book to try and smooth out the flow and stabilize prices. Is that roughly correct?
Yeah, that's roughly correct. So
So,
And I think that there's another element too where, because the liquidity in crypto is fragmented across different exchanges, the market makers and the ecosystem play a key role in making sure that prices across all these exchanges remain largely in line with each other, and they don't deviate based on where there might be more or less activity. So you often see exchanges like Binance or OKX being the primary source of liquidity, but these tokens might also trade on some of the lower volume exchanges. And so, if a trader doesn't have access to maybe Binance and he has to go trade on one of these other exchanges, it's imperative for market makers to be in the space. Maybe if that person's buying on a lower liquidity exchange, a market maker would sell it to them on that lower liquidity exchange and then go and buy it on Binance. And that way, the prices will remain in line, and it adds liquidity and depth to pretty much across the spectrum in other exchanges as well, where it might
so
not
this
be
is
there organically.
so this is what might be called roughly an arbitrage function. You're buying and selling on multiple exchanges, trying to keep prices relatively level, relatively stabilized. Obviously, it's a profit in that business when you can buy lower and sell relatively higher.
Correct.
Jump
Yeah,
back.
that's exactly right. And I guess just to sort of finish the thought and close the loop on the difference between market making and OTC, is that OTC is a different clientele. So I think the OTC business caters more towards institutional counterparts that are looking to transact and express a view in the marketplace bilaterally. So they face off against our desk principally, and there are a lot of benefits to trading OTC. But I would say typically the end user of that product is more asset managers, hedge funds, protocol treasuries, miners, venture funds, ultra high net worth, etc.
Okay, so just to explain this for retail investors who may still be struggling with it, OTC, we're talking about trading over the counter here, meaning not on exchanges, and the ability to do these trades sometimes at scale, I would imagine, and to attempt to get better execution. And they're trading against you in the sense that you essentially become more of a principal than an agent on these types of trades.
That's exactly correct. So we basically warehouse that risk and we manage that risk as we see fit. All of this is really a risk transfer exercise. So ultimately, these exposures end up being bought or sold, typically on some sort of exchange or liquidity venue. But the benefit of trading OTC, um, for the institutional counterpart, I would say would be tighter spreads, less market impact, anonymity. We can offer complex algorithmic strategies and liquidity access to exchanges that they might not have access to, as Greg alluded to. And then there's a risk management component too. An asset manager does not need to have exchange accounts and inventory sitting across a multitude of exchanges when they can just face off against one trusted over the counterparty.
Reed, maybe we could walk through a couple examples probably easier for folks to understand when they hear a specific example rather than sort of the generalized analytic explanation. So let's explain and give some examples of each of those business lines, just so people can understand and get their head around what's actually happening behind the scenes.
Sure. So an example of an OTC trade would be that Ash is running a hedge fund, and he is an onboarded counterparty of Flowdesk. To be an onboarded counterparty of Flowdesk, you have to go through a rigorous KYC and AML process. Once that is complete and you are onboarded, you are good to trade. So you come to us, Ash, and you say, you know what, guys, I'd like to buy 50 Bitcoin. Can you show me a price? Greg, who runs the trading desk, will look at the market and a number of different statistical or analytical inputs, and he will price that risk. He will show you an offer. Let's say Bitcoin's trading at 65,000. Maybe he's showing you an offer at 65,020, and you say, "Okay, that's done. I lift you." We are now short those tokens essentially on our desk, and we have to go into the marketplace and manage that risk and cover that risk potentially, unless we're trading out of inventory that we have. But as far as
Right.
Ash is concerned, you are long those tokens at $65,020, and that is essentially the end of the trade. Then we go through the settlement process, in which case you would send us the fiat or the stable coin. Once that is received and settled, we will then send you the coins.
Lift meaning buy at the price that it's offered.
Correct.
Yeah. Listen, let me explain this to folks here, why this is so important, why it's so critical to understand. You might say, ultimately, price is a function purely of supply and demand. That's true ultimately. But the important thing to understand here is these market structure issues, market mechanics, how underlying markets function are incredibly important in price discovery. And when you see dislocations in markets, when you see markets having challenges, breaking down, or just having wide spreads, understanding these types of mechanics is incredibly important, particularly when there are dislocations in markets.
Yeah, and I think one of the misnomers about OTC trading in general is that when a large counterparty maybe discloses that they sold a block of Bitcoin over the counter, that doesn't necessarily mean that the buyer of that Bitcoin is now just going to own the Bitcoin and they want the long exposure. More often than not, that just means that they're dealing with the market maker like Flowdesk, and that over the counter transaction happened, but we've hedged our risk almost immediately, whether it be seconds or minutes. We're typically going into the market and selling that risk on exchange. This could be expressed through spot selling. It could be expressed through future selling. It could be expressed through selling a different product that maybe has some correlation to the product that we traded. But ultimately, at the end of the day, a lot of the OTC trading that you might hear about or read about typically doesn't mean that pressure on the market isn't occurring. It's just there's a counterparty in between, which is typically a market maker, and then we're going and hedging that risk um, in our own way. Now, Reed mentioned, some of the impact with this that comes with this. Market makers like ourselves are typically better at trading tokens than your average, institutional firm, right? We have dozens of exchanges. In Flowdesk case, we have over 100 exchanges that we have access to. And so if we need to buy 50 Bitcoin, we're not just going to Binance and lifting the market, whatever we see there, right? We have algorithms and trading systems which allow us to access all of the different exchanges that you probably heard about at the same time. And instead of buying 50, we're buying zero point 0.1 here, zero point 0.2 there, maybe 1.5 there. And we're breaking this down into tiny cliffs. And so what it does is it sort of reduces our footprint. And so no one can really see that we're in the market buying. But B, it allows us to basically leg into the position a little bit slower and hopefully pay a better price than we would have paid if we just lifted the market all in one tranche.
All right, for some retail investors whose brain may be bleeding right now, let me try and translate that. So, when in Wall Street speak, you show the guy the price. He says, "Listen, I want to buy 50 Bitcoin." You show him a price. You quote him a price. He wants to be able to get that price locked in, know that that's what's going to be done. That's where his trade is going to be at, so that he understands his position. You guys may not necessarily own the position at exactly the level that you want to sell it to him at, or that he wants to buy at. So you're going out across the market, lifting the prices that are being offered on various exchanges, theoretically lowering the aggregate price, or the blended price on that, and hopefully doing it at a profit for you guys, while simultaneously also delivering value to the client, who's going to be able to get better price, better execution with you than they would if they tried to go across all those multiple exchanges.
Yeah, that's exactly right.
Yeah. we should say for folks who are maybe coming to us from the tech side, these parameters are all very well defined. This is just the way that trading takes place. For example, on the equity side, for large institutional clients who are looking to reduce their market exposure, and market makers who are looking, of course, to profit from the same activities on the opposite side of the trade.
Yeah, in a lot of ways, we on the crypto side have largely mirrored the equity trading strategy as well, both in terms of systems and algorithmic strategies. There are some key differences in market structure on the crypto side, most specifically the relationship between exchanges and clearinghouses and custody. That's obviously very unique on the crypto side. Anyone that's traded crypto in their own understands that if you want to sell one Bitcoin on Coinbase, you have to send that Bitcoin to Coinbase and you cannot sell it until it gets there. That's not quite how it works on the equity side, where the settlement of the equity side takes place after the fact. And so that's really the primary difference. But in terms of execution strategy, looks very similar to what traditional finance players will know in their equity days.
Really interesting stuff. Guys, I love having conversations like this. When I was one of the young guys on Wall Street, when I was in my 20s, these are exactly the kind of conversations that I wish I had the opportunity to understand, so I could understand exactly how markets function, which is really the reason why we're all here. Okay, so with all of this said, as we explain these relationships, now let's add on an additional layer of complexity, which is to unpack what's happening on the ETF side on both Bitcoin and Ethereum here in the United States. Guys, jump in, explain a little bit about the current state of play in those ETF markets and what's happening underneath the hood as these trades are taking place.
Yeah, sure. So obviously the Bitcoin ETF was launched back in January. The Ethereum ETFs were launched in July. I would say quite different receptions for the two. We don't have to replay all of the Bitcoin action, but as everyone knows, there was some initial selling that happened right after the fact. In hindsight, we found out it was largely directed from the FTX estate. After those first few weeks where the FTX estate was selling their GBTC consistently, market was able to rebound, and we've seen pretty tremendous inflows into those Bitcoin products ever since. We looked as of yesterday or the day before, the AUM for these Bitcoin ETFs was somewhere in the $16 to $17 billion range. Just a tremendous amount of capital raised into these funds, and I think it's a great testament to the demand that was there for Bitcoin, and I think it's been obviously great for the price action of Bitcoin. At this time sitting somewhere around 20. This time last year, sitting somewhere around 25,000, and then up at $57,000 today, largely attributable to these ETFs. On the Ethereum side, launched in July, we've seen certainly less interest. I think one of the unique things about this launch specifically, both in Bitcoin and Ethereum versus other ETF launches, is that there was already an existing product in place, and there was clearly demand to sell that product once it was converted to an ETF. And so we saw it with the Grayscale outflows in Bitcoin early, and we saw it again with the Ethereum outflows. This chart shows a pretty good picture of what happened. Effectively, back in the 2020 and 2021 days, Grayscale raised a ton of assets, and there was no redemption mechanism because it wasn't an ETF; it was a trust. And so, when there was, when supply of these ETFs outpaced demand, the only thing it was able to do was to trade at a discount because you couldn't redeem it. Typically, the redemption mechanism, the creation redemption mechanism in general, is a way of balancing supply and demand. And we can get into more of those details later.
Let me just jump in and explain this here. Yeah. This is such a critical concept, particularly since it inverted, that it was trading at a massive premium for a significant period of time before it then flipped and was trading at a steep discount. I think about 50 cents on the dollar. The idea about redemption mechanisms and the reason why all of this sort of nuts and bolts market structure stuff matters is because obviously it influences price, and you just didn't have the ability without ETF approval from regulators here in the United States to be able to have a mechanism, something that tracked very closely the price because of the redemptions. You weren't able to create and destroy those at will. I don't know if you want to add something to that, Greg. You have a much deeper understanding of the mechanics of how that works.
That's exactly right. So the typical way a creation or redemption works is basically the supply. So typically, if you look at supply and demand curves, right, as demand goes up, if supply stays the same, the price is going to go up, and the same works on the opposite way. If demand goes down but supply stays the same, price is going to go down to reflect that. The nice thing about ETFs and why they're so easily able to track their underlying index price is that the supply is flexible. It changes every single day, and basically by being able to change the supply every day, it allows the price of the ETF itself to maintain directly intact with the price of the underlying. So in this case, Bitcoin or Ethereum.
Hey, Ash, I think if I could just take a step back here for the audience and try and unpack a little bit of the market structure here and like what it actually means for Flowdesk as it relates to the ETF, I think might be helpful. So
Please.
Flowdesk serves as an LP to multiple ETF providers, and an LP stands for liquidity provider, right? So the way that it actually works is that as an LP, we provide liquidity to the issuers, whether it's Grayscale or many of the others, and we do transact with multiple ETF providers to facilitate creations or redemptions, which you've mentioned already. So the way it works mechanically is that the AP, which is authorized participant, and in this case, it could be one of the banks, they get an order from their customer to create or redeem shares of the ETF. And then the AP then turns around and goes to the LPs more or less to communicate that order and to get a bid or an offer on that particular flow. So as an LP, what we do is we respond to the ETF providers, the ETF issuers rather, and we respond with pricing, or we make them a market, whether they're buying or selling, creating or redeeming, and then we facilitate that trade and we settle that trade with them. Then there's a settlement process that takes place on the back end between the buyer or the seller of the actual ETF and the AP.
You want to unfuck your shit? This is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
Yeah, and so I would say, that it leads into directly how the price of these underlying assets, whether it be Bitcoin or Ethereum, is directly tied to the inflows and outflows of these ETFs. So for a very basic example here, if an ETF, if there's a client that wants to buy the ETF, they need someone to sell them that ETF, right? Whoever sells them that ETF then needs to go buy that Bitcoin somewhere, basically through the trust. So, or through the ETF, I'm sorry. So if you want to break this down in a very simple sense, Ash's hedge fund wants to go buy IBIT, right? That's the BlackRock Bitcoin ETF. Ash's hedge fund is going to go buy that ETF from a hedge fund, and to hedge that, from a market maker, and to hedge themselves, the market maker will then go out and they'll buy an exactly identical amount of Bitcoin to hedge themselves. So that market maker is now short the ETF to Ash, and they're long the spot Bitcoin to be a perfectly hedge. That purchase of the spot Bitcoin will impact the market the same way any buy of any spot Bitcoin would anywhere else, right? So that is the relationship between these ETFs, the inflows and outflows, and the price action ultimately is that anyone that's buying the ETF is effectively buying that exact amount of Bitcoin off the spot market, and so it's directly attributable to when you're looking at price and these inflows. That's sort of how it works. Now,
great. Let me just jump in there because that's such a critical point and so important for people to understand. The authorized participant ultimately wants to be flat. When a bank is selling one of these, they don't want to have underlying directional exposure to the price. They want to be able to sell their client what the client needs, offset that against another position. That's why they're going to you. That's the important part, I think, for people to understand.
Correct. Yeah. So I think a lot of the times when people are saying like BlackRock's buying Bitcoin, it's like BlackRock's not really buying Bitcoin. Maybe they are, maybe they aren't. But ultimately, this is some end investor who's buying the BlackRock Bitcoin ETF. And then in order to fulfill that order, BlackRock is coming to a liquidity provider like Flowdesk to look for an offer on that Bitcoin. And then that Bitcoin basically just sits in the trust, and it's reflective of whoever bought those ETF shares, that's their share of the Bitcoin that sits in the ETF. And so the ETF is effectively just a wrapper to help investors custody their Bitcoin or their Ethereum, and it allows them to trade that wrapper on a secondary market exchange that's a trusted venue. It can sit in their E-Trade account or the Schwab account or whatever account they might have. And ultimately, it gives investors a way to hold Bitcoin with confidence that they don't have to deal with exchange risk. Obviously, we saw a bunch of exchanges blow up back in 2022, I guess it was,
Right.
and they don't have to worry about self custody. Obviously, self custody is its own headache for people that aren't doing this every day. And so, there were probably a lot of people before the ETFs came out that said, "I'd love to own Bitcoin. I just don't want to deal with this. I don't know how to deal with this. Maybe
Right.
my bank won't let me wire money to Coinbase." This whole process was it had a lot of friction before. What the
Right.
ETFs have largely done is it has removed pretty much every bit of friction that existed before to buy Bitcoin and Ethereum.
Yeah, and this is one of these great conversations where every idea seems to build on the prior one. So, in other words, if you're a retail investor who wants to take a long position in Bitcoin or Ethereum, you're an institutional investor. I mean, it could be a whole series of different reasons why you just don't want to deal with the underlying custody issues. You don't feel like you have the expertise in this. You just have a view where you're long Bitcoin, for example, and you want a way to express that view in the market. Makes a lot of sense for a lot of these investors that they might just want to go in and buy an ETF. It's something that's already on their platform. They have the ability to do it, and it simplifies dramatically the issues of custody and all of the challenges that come with owning crypto, particularly at scale.
That's exactly right. And I think even beyond maybe you might even have the expertise, like even somebody like me, right? I have all the expertise in the world of how to buy and hold Bitcoin. But if I have a retirement account that I can't, I can't put my ledger on a retirement account, right? Like I only have so many options. ETFs are a great way to buy Bitcoin in retirement accounts that previously wasn't there. Obviously, as we know, the total addressable market of the retirement accounts in this country and probably globally is in the multiple trillions of dollars. So beyond just expertise or even just wanting to, I think it actually opens up a huge swaths of money that previously couldn't buy digital assets that now can.
Right. Read anything to add?
Yeah, I think that while although one could make the argument that the introduction of these ETF products could potentially have some negative effects on market structure just from a price action perspective. I think by and large, this has been a net positive for the space, for investors, for the legitimate legitimatization of the ecosystem and the asset class. I think that it's taking us a step further for some level of regulatory clarity. I mean, I think this is kind of step one, possibly step two in that process. So I think that by and large, this has been a good thing for the space. It's been a good thing for the asset. It's certainly been a good thing for all of the market participants in the crypto ecosystem. So we view this as a net positive.
Reed, let's dig in one level of detail further there and talk about why, in your view, this has been a net positive for the ecosystem specifically. And of course, you mentioned that some of the potential risks. Talk a little bit about the potential risks as well as the potential upside for the ecosystem and for investors in aggregate.
Yeah, I think when you take a step back and you look at the inflows or outflows in these particular products, they do tend to, weigh heavily on the price action of the market. So I think if you are looking at the crypto ecosystem as a standalone product or standalone asset class or universe, I think that there is a degree of price impact that has been the direct result of these creations and redemptions, which some people could potentially view as being negative, sort of going against what the initial sort of thesis or vision was for a decentralized financial product that essentially is providing people with financial freedom. But I think that upon further review and understanding of the ecosystem at a large, I think what this has really done is it's enabled large institutions and asset managers to wade into this world, whereas before it was largely impossible for a variety of reasons, whether that's regulatory, whether that's on the settlement side, the custody side, etc. And I think that we've seen quite a few counterparts that were on the fence, hedge funds, for example, that wanted to trade digital assets but couldn't wrap their heads around doing it, or they were prohibited for doing it for various reasons, according to their mandate or whatever else. And this has enabled them to, enter or join the party, so to speak. So, from a capital inflow perspective, I think this has been very good for the space.
Greg, anything to add?
No, I think that's well said. At the end of the day, this is always going to come, and it's certainly something we're always going to have to deal with in terms of some of the negative side effects that Reed mentioned. I do think it's important if we're here to build, we're here to build a sort of a separate ecosystem of finance, and I think that having an Ethereum ETF, for example, where you could just buy Ethereum, have the price appreciation aspects settled over there, but you don't have to actually get your hands dirty and start using Aave, for example, or Uniswap, right? Like those are some of the things that I think in order to take this industry to the next level, those are the types of products that are going to have to become mainstream um, in order to build this decentralized financial ecosystem. This certainly, well, from a price appreciation standpoint, it's certainly good. For an actual adoption of crypto, it might not be as good, as it's sort of just allowing us to easily blend into everyone else's portfolio and become some part of the allocation of your typical 60/40 or whatever you want to call that portfolio allocation. So it comes with its pluses and minuses. I think that we as an industry just have to continue to keep building um, and hopefully onboard more users to the actual decentralized finance space, and not just people holding IBIT or holding Ethereum ETFs.
Well, Greg, you teed up what may be the critical point as we build this conversation layer upon layer. Let's talk about this. Let's talk about the relationship and your view of the relationship between adoption of the ETFs, of the spot ETFs here in the United States, and the underlying price. Obviously, we can look at a chart like we did before that shows the inflows into these products and plot it against price. Always difficult to know which way the causal arrow is pointing when you see those correlations. But talk a little bit about how you guys feel about the adoption of these products, its relationship to price in the industry, and whether or not, like, which direction that flows. Talk about a little bit about that. Read first to you.
Sure. So I think there's certainly a direct impact on price as it relates to the creations and redemptions. And typically, although a lot of these ETFs have slightly different mechanisms or windows, you can certainly see the price action reflected in the marketplace on days where there's large inflows or outflows. Some of these ETFs have like a 3 p.m. to 4 p.m. Eastern time window where they are buying or selling the Bitcoin to essentially hedge their ETF exposure, as Greg mentioned. So there are many days where you can look at a chart for Bitcoin and you can start to see it moving one way or the other at 3 o'clock. And the price action between 3 and 4 is usually, in many cases, reflective on the activity that's going on in the ETF world. So I think that's sort of the glaring price impact. In the beginning of the ETF launch, certainly, while although there was a huge amount of inflows, you certainly saw quite a bit of outflows from the Grayscale product, for example. And as such, as you watch the market mechanics work, from that, call it 3 to 4 window, or whether it's the 4 p.m. print. There's certainly quite a bit of overlap in what you're seeing on price discovery as it relates to those products.
Yeah, and I think too is something that has briefly been mentioned, but hasn't really been dug into before. One of the nice things about obviously the blockchain space is that you can see everyone's activity. Really, if we have our on-chain sleuths of this industry who are constantly tracking wallets and movements and who's sending what to exchange and who's taking assets off exchange, and so in a lot of ways that typically helps drive get ahead of potential price action. If you see somebody send thousands or tens of thousands of Bitcoin to exchange, you can typically look at that and say, oh, some selling is happening, price probably goes down in the short term. Or when there's a huge amount of tether minted, you could say, oh, look at this, they're going to go buy digital assets with that tether. And so there's certainly been a lot of front running based on on-chain movements in the past several years. I think one of the things that these ETFs almost broke in that model is that because we're taking this sort of TradFi settlement approach to the crypto space, a lot of the settlement occurs after the fact. And so I remember early days, there were people who were tracking like the Grayscale wallets, and they'd be like, "Oh my God, Grayscale just sent 50,000 Bitcoin to Coinbase. They're going to dump today." In reality, those had been sold the day before, and they were just making a settlement for trades that they had already made with market makers like ourselves. And so, I think that it's notable that just because we're seeing the inflows and outflows on a given day, that doesn't mean that the price action is going to reflect in that exact moment. A lot of the times, the trading and the settlement has happened after the fact, and the market impact has typically already occurred. If you're finding out about it on Twitter, the price impact has already been felt, and you're certainly not going to make any money if you're trading on any of this information that you're seeing after the fact.
And Greg knows that because he's trading ahead of you on this.
Sir, I would never say that. No, but it is important though, and I think that in general, like I sort of mentioned it earlier as it relates to the relationship between the end investors and the ETF market makers. Typically the price action, the price impact is immediately upon the trade of these ETFs in the secondary market. That hedge is really the price impact of the market, and then after that, there's a whole bunch of things that have to happen to balance supply and demand, and to make sure all the ETF market makers are out of their positions. And I think that's less important for the average investor, but it does exist.
Yeah. By the way, important to point out that one of the things that makes a market is multiple points of view. There have been skeptics around the ETF space. I wanted to just jump in here and read a quote from our friend Jim Bianco. If we could pull that tweet up on the screen. Jim asks, who is buying these funds? Answer, small, tourist, online, retail. The average trade size is now under $12,000. This is the lowest trade size since March. You can see that on the chart there. And then Jim goes on at some length, and I want to give you guys an opportunity to respond because it does represent a different point of view. Quote, the spot BTC ETFs have not become a tool for TradFi or boomer adoption. BlackRock confirms this by saying that 80% of IBIT's inflows are from self-directed online accounts. Crypto quant analysis suggests that most spot Bitcoin ETF inflows were from on-chain holders moving back to TradFi accounts. So very little new money has entered the crypto space. So far, these instruments have not lived up to the hype of here come the boomers. Very few have come, and those that have are holding losses and may now be leaving $1 billion worth of outflows over the last 8 days. Obviously, that may be a little bit stale today. But guys, talk a little bit about this skeptical position of folks who say, you know what, really, there's not new money coming into the space. This is just being retread from various other spots. Do you have a view about that?
So I think that from a statistical perspective, I'm sure that Jim did his research, and I'm sure there's some validity to whatever it is that he posted. I have not read through that thread well, but I do see it's dated September 8th, so it's relatively recent. I would say that, to counter that, I would say that, if you look at the numbers, I think that these products historically have been the most successful ETF or ETP launches in history. So I think you kind of zoom out a little bit and sort of understand, what's happened here. That has also been reflected in all the 13F filings that have been put forth by some of the largest hedge funds and asset managers in the world. So when he said there's really no new money coming in here, well, although that might be the case in September, I certainly don't think that applies to the historical narrative. Additionally, I think that we've been in a relatively low volume, low interest, depressed market sentiment environment for the past couple of months. I think that is a product of the summer doldrums, which we usually see cyclically, but also there's certainly a lot of macro things at play here as it relates to the macro environment, what's going on geopolitically, the election here in the United States, et cetera. So I wouldn't necessarily just take a snapshot of September September or the latter part of August and make an assumption that these products from an inflow perspective are irrelevant. That's certainly not how we see it.
Right.
And I think that we probably have a slightly different view than maybe a research platform.
Yeah. Well
Yeah.
said.
I also I
ETPs
also
being the
think it's
superset of exchange traded products, just for clarity. Go ahead, Greg, please.
correct. Yeah. I would also say that this is one of the rare examples of an ETF launch where you could actually legally front run this ETF launch for months. It was pretty transparent that these were going to launch in January for probably 3 to 4 months before they actually did. And really in October, it started to take shape. And we obviously saw that in the price action. Last September, we were sitting around 25K, and today we're sitting at 57K, having traded as high as 72K. So, I do think there's an element of you could have easily bought as much Bitcoin as you wanted, knowing that these were going to launch and that there was likely going to be some price appreciation associated with the new money that's come in. Um, I said earlier, there's roughly 16 to 17 billion dollars of assets of Bitcoin sitting in Bitcoin ETPs just in the U.S. here alone. So, with all that said, you could obviously look at a snapshot today and say that maybe things aren't great today, but I would challenge anyone to find me any ETF launch that's raised anywhere close to 16 or 17 billion dollars within a few, inside of a year. I think it's been a resounding success. I would also say to further Jim's point, it's always hard to tell what the inflows actually are. There's been a big basis trade. So for people who don't know what the basis trade is it's a funding trade where you can buy, for instance, in the GBTC or in the Bitcoin ETF cases, you can buy an ETF that holds Bitcoin and you could sell a Bitcoin future. Typically, the Bitcoin future will trade at a premium to wherever the spot market is. And that spread there is actually, if you just sit on it for the duration of that future, that spread will collapse to zero. So what we've seen a lot of TradFi players actually buying these ETFs as an expression of this basis trade, not because they want upside, BTC price action. They just want to collect an arbitrage, and it's basically a different way to get interest on your dollars. Right? You have to spend dollars to buy the ETF. You don't have to spend dollars to sell the future. And then basically the difference of those two prices is your positive P&L for this trade, and that acts as interest on your US dollars because you're delta neutral on this position. You're long and short, almost identical products that are trading at a different price. So in a way, it's arbitrage. In a way, it's funding. It's a funding play, and so a lot of the inflows that we've seen have been related to this trade. So I could sit here and say 16 or 17 billion dollars of inflows, but the reality is multiple billions of that is certainly related to this delta neutral funding strategy as well. So I don't think anyone truly knows what the impact is going to be today or what it's going to be longer term. What I do know is mechanically speaking, we've certainly reduced a lot of friction to buying Bitcoin. And over the long term, I think if you look at this over 2, 5, 10, 20 years, it's certainly going to help. If Bitcoin ever does become what we all expect it to be, this will only help that process in terms of the price appreciation of it.
And presumably the market depth and liquidity.
Correct. Yeah, it's certainly added a lot of liquidity to the market as more players have come in. There's just a ton of volume on these ETFs, and all of that volume directly contributes to the volume on exchanges too. Coinbase specifically has seen a large uptick in volume this year because a lot of these ETF market makers are also active. These are U.S. companies that maybe don't have Binance accounts or OKX accounts. We're talking about the Jane Streets and the Citadels and the Susquehannas, right? Like they have crypto trading arms as well, which are, but their ETF arms are U.S. companies, and therefore, I'm sure far more comfortable trading on Coinbase than anywhere else. So that's definitely contributing to, and you can see the volume metrics just if you look at the volume metrics during U.S. hours versus non-U.S. hours. The liquidity is certainly much better during U.S. hours. So it does help in that sense as well.
Guys, looks like we've got a question from one of our viewers. This comes to us from Jake on the Real Vision website, who wants to know, are there any regulations in place that prevent market manipulation specific to OTC desks?
Yeah, I think by and large, I mean, we follow the same set of standards and rules of the road that TradFi would. In everything that we do, we are constantly, have the regulatory landscape top of mind. Unfortunately, there's been a lack of clarity in that regard, at least onshore. So it makes it a bit more difficult to operate in the space. But we certainly approach the market with the highest level of integrity that we possibly can, and we more or less take the same set of standards that we would have from the TradFi world. And I think it's important to understand that these ETFs um, were, I would say, step one in sort of the broader adoption process, and step two would be that regulatory clarity, which we are so you know hopefully waiting for in the near future, and likely a GSIF or a large bank to participate that includes some form of clearinghouse that they're more used to in TradFi. So I think from an individual adoption perspective, these things help, and a clear use case and utility and education and easier custody solutions also lend to that.
Greg, anything to add?
No, I think that summed it up nicely.
So, guys, listen. As we come to the conclusion of this conversation, I think it's always fascinating to have market professionals on to give a sense, because obviously, as you sort of alluded to there, Reed, the spaces kind of rhyme, right? Obviously, crypto is a very different world than traditional finance. Digital assets very different, for example, from U.S. equities. But it is fascinating to see how all of these market structure issues have sort of replicated themselves or are being played out now in a different form here in the crypto space. And I think we have just a great deal to learn from having conversations like these to talk about these types of issues that are just so important to understanding the market structure. As we reach the end of this conversation, I want to go to each of you to give you an opportunity to give us some final thoughts, key takeaways from this conversation. Greg, first over to you.
Yeah, so I think just in general, as it relates to the ETFs and the role they're playing, I think it's going to be important to continue to watch the adoption of these ETFs. I think, at least for what I think is unique about these ETFs is people in the traditional finance space, or just even in the retail accounts, there's a lot of just consistent buying of assets. People are allocating certain percentage of their paychecks to their E-Trade accounts, and I think that you could start to see patterns, and you start to see more consistent buying pressure for when you have these TradFi products. And so I think that's going to be an important thing to watch. Is the interest going to remain there for these products? Where we go from here, it's clearly hard to say. We've obviously, we've had a bunch of large supply events in the last few weeks and months that are sort of working itself out, and I think you're starting to see um, the impacts of that on price now that we're back down here in the 50s. But we've done an okay job at absorbing them all, and I think the ETFs are in large part supporting that. So we'll see. We're certainly watching, and we're certainly happy to be a part of the ETF space, and we hope it continues to grow in a big way.
Read over to you. Final thoughts, key takeaways.
I think, I think more broadly, it's just important to keep top of mind that we are in a very macro and sort of geopolitical environment right now that's seemingly driving a lot of the price action across all risk assets. Bitcoin obviously is sort of the king of risk assets and digital assets in general. So we remain very positive on the space, and there's an endless list of positive updates and statements that have been issued and made recently over the past couple months, and I think that will continue. We're very excited about what we're doing here at Flowdesk, and I think at the end of the day, none of us would be here if we weren't extremely bullish, optimistic, and excited about the asset class and believed in it. I know that we certainly do here at Flowdesk, and we'll continue to kind of put forth the best products that we can for our clients, and continue to push the ball up the hill, so to speak.
Reed, Greg, thanks for joining us. Great conversation, a fun conversation. Definitely an interesting one for our viewers and for our listeners. That's it for now. Once again, a quick reminder about Real Vision's 10th birthday, currently offering a discount under the code BDAY10, BDAY10. I'll be back in about an hour with a trade idea from Tobias Carlisle. Thanks for watching. Thanks for listening. Have a great afternoon.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.